where you take the facial recognition, fingerprints, and so on, and then build layer after layer payment systems on that. Now, these are all domestic. These are advances in the domestic system. The key point still comes, how do you link up payment systems across countries? And this is where the current account-based system really comes up to its limits, because if you have a payment system in one country, it's underpinned by the central bank. Although Usman says most money is private, that's only half true, in that money is indeed deposits of commercial banks, but it's underpinned by the central bank. So in that sense, it's not a purely private money. It is underpinned by central bank money. But how do you link up payment systems across two countries? And this is where the current account-based system really comes up to its limits, because then...
Thank you.
Okay, very good. Thank you very much. So we had, I think, a wonderful overview on some conceptual issues. I think he took us back a little bit to history. Stablecoins are not a new thing. In fact, indeed, the gold standard itself, paper money was backed by reserves in gold, and very much was like a stablecoin. Uruguay is the most important, one of the most important use cases. Sadly for me, it wasn't a blockchain-based approach, but nonetheless interesting. And I think Adrian brought up a very interesting case of this idea of synthetic CBDC. Can the central bank play a role more as a backstop, even though that's a dirty word when you come from the UK at the moment, but leave innovation to the private sector and offer the trust that the central bank can lend to the market in order to have an effective settlement medium. And I think maybe the USC coin, this consortium, comes very, very close to your proposal. Look, these are exciting topics. Let's open up the Q&A for the public. Please, are there microphones? So let's collect 2 or 3 questions and then allow the panel to sort of answer it. The gentleman, yeah.
Yes. Good morning. Just for full disclosure, I'm José María Orlán, chairman of the Spanish Banking Association. So my question is not going to be neutral or scientific, okay? I'm listening to you guys, and it's very interesting what you're saying, but there's for me something that is a little bit confusing. What are we talking about? Are we talking about replacing notes and coins? Or are we talking about replacing or creating something that is very close to bank deposits? If it is the first one, no problem whatsoever, There's so much competition in the payment system that is not anymore a source of banking profitability. In particular in Europe with PSD2, it's mission impossible to make money from the payment system. So that, it's fine. I mean, cash is very dirty, it's very costly for the banks, and to create a more effective payment system, okay, that's fine. If we are talking about creating something that is very close to bank deposits, then, I start to have other type of financial stability concerns, because I think that in particular in stress times, that can be very close to bank deposits and safer. And then you can have a run on the bank deposits in the middle of a crisis. And going forward, if that is the case, who is going to give, who's going to finance the economy? Who's going to do maturity transformation?
Very good. The gentleman on the right there.
Good morning. I have to say that, the question that was just posed reinforces my thought that I think there is a lot of bias against digital currencies, both on the part of policymakers and on the part of issuers. I would refer back to history. In history, there has always been a clash between publicly issued currency and a privately issued currency in competition. And the latter, the private issuing, has always been the case. Even Bitcoin, it has come up. The problem is that at one point, competition and misgivings by issuers has created the need for public monopoly and fiat money. So the bias of policymakers is to think that inherently fiat money is more trustworthy than privately issued money. In Weimar's Republic, that was not the case. In many financial crises today, if you want to move out your deposits before capital controls, Libra or whatever is the best option you have. So this is the bias. There is a bias from banks, because they fear a lot about losing their delegated public monopoly, because the state and the central bank have delegated banks in exchange for supervision vis-à-vis banks. So I would take a more unbiased approach, and I think that the synthetic digital currency that was illustrated by Tobias could be a very good case in point, because the technology has changed. So now public monopoly is maybe not as efficient as a private, well, not a private, a digital currency. Of course, the key point is trustworthiness. So there could also be privately issued currency which are publicly regulated.
Very good, thank you. The gentleman, the gentleman in the back that was first, yeah.
Hi, my name is Manuel Conte. I was a former director of Treasury in Spain. A distinction which I'm missing in the discussion as well as in the paper is between the old distinction between outside and inside money. And my claim is that industrial countries at least are never going to allow the emergence of a private outside money, because this goes to the core of the concept of money being a sovereign prerogative. And that's why I think Libra, to the extent that Libra is meant to be an outside money, even though there is some backing by a basket of currencies, is a Hayekian private currency. And my assumption is that the G20 or any countries are never going to allow parallel currencies together with the national currency. So in the US, it would be unthinkable that President Trump would allow an explosion of Libra as a general means of payment within the states. In Germany, exactly the same. So sovereign states are going to be always against parallel private currencies, in spite of Hayek's wishes years ago. And they are going to find measures to prevent that from evolving. And I think this distinction is key, because with inside money, that's fine. There has been throughout history many types of inside money, and it's a question of efficiency. But when it comes to outside money, creating a new currency, I think my guess is that countries are going never to allow the appearance of Hayekian new private currencies.
Very good. Let's allow the panel to respond, and then we have a second round, please. Who would like to start? Go ahead, please.
So let me start with the first concern, which is that, of course, the banking system is conducting maturity transformation, credit transformation, and liquidity transformation. And these are extremely important economic roles in the economy. And stable coins can potentially undermine, and central bank digital currency in particular, can potentially undermine this very important economic function. And of course, central bankers are very concerned about that. Any form of central bank digital currency should not undermine the commercial banking system and should not undermine this very important economic role. So I agree with the proposition that stable coins would probably be something very small. And so one important policy lever that I haven't talked about yet is what is the interest on reserve that a stable coin would earn, right? And this is anything from the interest on excess reserves, in which case it would be very similar to a bank deposit, to zero, or something negative, right? But the key thing here is that it's a policy variable, right? And so it could be zero, in which case it's very similar to cash. But in times of crisis, it could be turned negative. And when we're in a negative yield environment like we are in Europe today, actually being able to put negative interest rates on cash is something that is extremely appealing from a monetary economics perspective. So this is an added benefit, is that you could potentially put negative interest rates on cash. So that is number one. Number two is this question of inside versus outside money, and would authorities allow there to be private money? I mean, I think what Hyun illustrated is that when we look back in history, private money creation is problematic because we need a lender of last resort, which is why central banks were created, why the Bank of Spain was transformed from a private bank into a public institution. We need the lender of last resort, number one. And number two, it has to be that somebody is responsible for overall money supply, right? And that is what Friedman and Schwartz is teaching us, right? So even if there are private monies to some extent, still some institution has to make sure that overall money supply, taking into account the supply of these private monies, is appropriate in order to ensure price stability, right? So these are two very important roles for the central bank. And let me just add here that in many countries, money market mutual funds have existed for decades and have been a very close substitute to money. And so we have been living with private monies, or something very, very close to private monies, for a very long time. And in some jurisdictions, these private forms of monies are quantitatively large, right? So in that sense, it's actually nothing new. The design, how to frame policy around stablecoins is really important because they are dangers. There are financial stability dangers, there are disintermediation dangers, and there are, of course, these international capital flow dangers that we can elaborate on further as well.
Very good, very good. Maybe for the benefit of the audience, just to clarify, indeed, most monies today are private. Right? So when we talk about currencies, it's a very small subset of money, only typically in the euro system about 10% of bought money. Most money already is private. Jorge.
Yes, thank you for the questions, and I agree with Tobias in the sense that it's very important to preserve the good things of financial intermediation, and we in particular in Uruguay are very concerned about that, about the effects of digital currencies on bank intermediation or in bank intermediation. And of course, the pilot of e-peso was not account-based. So it's a token which is that operates through this system I described. So in that sense, again, the design of the thing is very important. And the design of the thing could put some limits to the wallets, because the final objective of e-peso is to serve as another representation of the Uruguayan peso as cash. So in your wallet, in general, you have a limited amount of cash in order to pay transactions in day-to-day basis or something else. So the same idea could be replicated to the limit on the digital wallets in order not to de-intermediate in some sense. Since it's not account-based, it's not will not pay interest, even negative interest. So in that sense, banks will still reach a new equilibrium in which they use and offer these e-peso link products to customers and make business over there. So there is a balancing between challenge and opportunities for the central bank, but also for the industry in the case of Uruguay. Related to the synthetic central bank digital currency, I like the idea. I personally like the idea. In particular, in Uruguay, I guess in other jurisdictions, there are something similar to that. There are limited licenses to electronic money providers. But the thing is that they are good, they innovate, they are private-owned with all the stuff. But what happens in the worst-case scenario? What happens in a time of crisis? This is the acid test as a central bank, we should take care of. So to preserve the basic payment infrastructure is very important. And I am not sure, I'm not completely sure that the design, the actual design at least, of these electronic money providers guarantee the infrastructure in the case of crisis. And this is a concern for a central bank, a concern that is long in history from the creation of lending of last resort. It's just that, it's just to provide liquidity through the channels. So the main channel was cash, but in the digital era should be another representation of cash or another representation of the channel, the infrastructure. So this is the main concern from my point of view as a central banker.
I think it's, so I spent my presentation talking about the wholesale payment system, which is about the payment system rather than money as such, although I think they're very closely related. But let me say a few words on the retail side, since most of the discussion so far and the questions have focused on the retail side. Now, money is already digital.
Yeah.
If you use your debit card, if you use your phone app, it is not actually someone writing in a ledger longhand. It is actually digital. It is actually digital. If you look at Sweden, they have a payment app called Swish. The look and feel of that is exactly like what you would expect with any other phone app. It's very convenient, but that's a bank-based system. Now, why is it that we have a lot of discussion on retail innovation? I think the primary reason is that there is still dissatisfaction with the cost and the speed, especially for cross-border payments. I think it's fair to say that in terms of retail payments, most of the huge advances that we have seen in the last decades have been in the user experience. It's in the domestic payment system, as opposed to the cross-border. And as Tobias said, I think there is still a long way to go, especially in developing countries, in financial inclusion, in bringing those people who are excluded from financial services into the benefits of financial services. Now, what are the impediments to that? So one type of impediment is the basic issue of how do I know that you are who you say you are? So digital identity. That's a kind of very basic type of issue. And there are ways of solving that problem, although there are debates about privacy and so on. There are biometric ways of establishing digital identity. In India, they've made huge strides in enrolling the bulk of the population in their digital ID program called Aadhaar, which is where you take the facial recognition, fingerprints, and so on, and then build layer after layer payment systems on that. Now, these are all domestic. These are advances in the domestic system. The key point still comes, how do you link up payment systems across countries? And this is where the current account-based system really comes up to its limits, because if you have a payment system in one country, it's underpinned by the central bank. Although Usman says most money is private, that's only half true, in that money is indeed deposits of commercial banks, but it's underpinned by the central bank. So in that sense, it's not a purely private money. It is underpinned by central bank money. But how do you link up payment systems across two countries? And this is where the current account-based system really comes up to its limits, because then the quickest way would be just merge the two RTGS systems. And that would be like saying, if I'm a bank in Spain, I could have access to the central bank where I will send my central bank in the jurisdiction where the recipient lives. And that, of course, is a huge step which cannot be undertaken easily, not least because someone has to check who these people are, and you don't want whole departments of the central bank checking on checking on know your customer rules. So you have to sort of trace where the money comes from. Is this a genuine payment? Is this actually illegal activity, and so on? Typically, those checks, the KYC checks, know your customer checks, are done by commercial banks. That division of labor has served very well, certainly in domestic payments. But again, it's the cross-border element where we come to the limits of the current account-based system. Because what you need to do is to find a chain of balance sheets. So if I want to send my money to another country, to a recipient in another country, I need to find a chain of balance sheets where at each step, both the sender and the receiver hold deposits in that bank. And then ultimately, the money is credited to the account to the recipient. As Usman was explaining earlier, these digital tokens are a leap in that respect, because what happens is they are transferred peer-to-peer. So you don't need to go through a balance sheet. You can just look up the list and say, yes, here is this bank, which is the bank of my friend that I want to send money to, and I will just instruct my bank to send a token. You don't have to go through the chain of balance sheets. This doesn't mean that you can forget KYC. You still have to do the KYC. You still have to do the checks. And it does mean that, though, that you are reducing the steps. However, someone has to be running that whole network. So it has to be a network of banks that are members of the system. And so, when we see this kind of system, it's just the virtue of sending the tokens is not going to solve that problem. Now, if we were to expand the e-peso example globally, what we'd need to do is to have a telco, a telecoms company, which would do all the KYC, and then there'll be one telecoms company who could do that. So in a way, the KYC is being done through the telco rather than through the commercial bank. So I think there are many, many architectural issues, but the one killer app is the cross-border payments, and this is where the token really comes into its own. So I think when we look at this from a policy perspective, we have to be very clear-sighted as to what are the technical breakthroughs, but what are the institutional backdoor work that needs to be done, the backroom work that needs to be done in order to make that system work. And I think the synthetic CBDC idea, I think, is very promising, the way that Tobias described it. But what he showed is only a very narrow slice of many, many things that are going to have to put in place behind that slide. So I think this is where we have to be literate about the technology, so that when we approach these issues, we can address what is feasible, but then not be glossing over some very hard institutional questions that have to be put in place. So this is a critical public infrastructure, and we shouldn't be playing games purely for the sake of experimentation. We have to be absolutely sure that whatever steps we take is for the public good. And this is especially, I think, the case for the payment system. So let me just stop there. Maybe we can have another round. Do we have another round?
Do we have another round? Excellent. I'd just like to just one reaction on the sovereign versus private, and I think it is, of course, a fair point. And I'd like you to think not only living here in the euro system, where indeed you may be content in using your currency, but most countries in the world have a very turbulent monetary history. There, the propensity to look for something else, where the fiat money is not necessarily the trusted standard. I think it is something that in this whole debate, please do keep in mind. Europe, the United States are not necessarily good references when it comes to thinking about.
The answer to that is we should have the proper public infrastructure there as well. So we should have a credible currency to begin with.
But it's just, I think, the propensity to sort of think beyond official currencies, you see, I think is, there is a driver there that I think you can justify by the mere fact that fiat has not always proven to be the trusted standard.
Yes, but what I'm saying is, yes, that's that is a typical tendency we see. But the prescription there is to fix the system, I would say.
Fair enough.
Yeah.
Fair enough. And looking at the complementarity, well, which could well be in the cross-border space rather than in national payment system. Okay, so we have a second round. We had already 3 logged questions. I'm afraid here on the Alicia, the first Jean-Pierre, and then the gentleman over there. So the first is the gentleman there. Yeah, please.
So, thank you very much. I'm Galo Nuño from the Bank of Spain. My question builds on the first question and especially on the reply that Tobias gave. So it's about the implication that this central bank digital currency has for the balance sheet of the central bank and the conduct of monetary policy. First, as Tobias has currently, in my opinion, underlined, the introduction of central bank digital currency would imply the implicit or explicit introduction of an additional interest rate that would be the interest rate that can be zero of this CBDC. And depending on the gap between that interest rate and the standard deposits rate, I mean the typical policy rates, the health of the banking system would be improved or deteriorated, meaning that it will control the degree of competition between the CBDC and the standard bank deposits. So I don't know, I mean, somehow it reminds me to this overnight reverse repo rate of the US. So I don't know if this is the kind of thing that you have in mind and how would be an appropriate way to conduct monetary policy in that environment. And conversely, and in the introduction of CBDC implies, if it's successful from the point of view of the central bank, and the introduction of a new liability that it will imply the introduction of a new asset. So I don't know if that's necessarily implies an increase in the size of the asset side of the central bank. And there is this very recent proposal by Markus Brunnemeyer and Dirk Nippel that what the central banks should do with this new asset is to reinvest it into the banking system in order to avoid all these kind of panics that the first question was referring to. So I don't know if you can develop a little bit on this proposal, I mean on those 2 points about the way to manage the assets and the way of control policy rates in such an environment. Thank you.
Okay, very good. So with Alicia here in the front. No.
Well, first, congratulations. It's really a very interesting panel. I have a question basically linking Hyunson's point on the cross-border consequences of what we're talking about and the synthetic central bank digital currency. And it's very simple. It's what will central banks do if they happen to have a central bank currency, not yet synthetic? If we manage to go there, it would be easier. You can basically impose reserve requirements. I'm thinking about dollarization, yeah? I mean, once upon a time, how would central banks reduce dollarization? Imposing higher reserve requirements. So you would have to have very negative, maybe, rates on, interest rates on your reserve requirements, on your synthetic digital currency. But the thing is, it would be issued by another central bank. Meaning you would have to treat these digital currencies unequally with the consequences that this may have. And is that something that would happen? You know, think about renminbi, think about Thailand, think about the Bank of Thailand, maybe not anymore here, could do about that because literally its bad monetary base may disappear otherwise. So, you know, I'm just thinking, synthetic is of course one of the solutions, but you need to take very bold measures on taxing that e-currency to get your way. So can you do that?
Maybe we can get Jean-Pierre Lando.
Let's go to the last, Jean-Pierre at the back, at the left.
Yeah, maybe some comments which are triggered by the first round of questions and remarks. Clearly, there is a concern that people don't want private entities to issue outside money or new unit of accounts. And I think the central banks and the authorities can kill that. They can prevent that if they want. They can kill Libra tomorrow if they want. So I'm not worried about the power of sovereign authorities to prevent unwanted monetary private initiative. The question is whether they can do that without repressing technology and technological progress and progress in payments. So there's a tension between those two objectives. Preserving the autonomy of monetary policy and the unit of account and outside money on the one hand, and on the other hand, letting new forms of money flourish, because that's what people want, as has been said. And they want it for many reasons. I think Hyun said about the cross-border, yes. And also, even in domestic payments, if you make an experiment, I have lunch with you, I can pay the lunch with my credit card, but then we want to share the bill. We cannot share the bill with our credit card. We can share the bill with our mobile, and tokens on our mobile. So the mobile money with the token, which is attached to it, is much more flexible in terms of payments than any existing, however fast they are, existing means of payment. That's where we're going. And that's what people want. And one of the most, I think, strong argument that you can hear is, how can I come send an email to my girlfriend who is in Japan, and I cannot send you $20, you are across the room. Right? So that is the problem that payments people have to face. And I subscribe totally to what Hyun has said, but on the other hand, it still reasons in a framework when you have what he said, a chain work of balance sheet, right? But what Libra brings is precisely very different. It's a network with tokens moving on that network. It needs an infrastructure, but it doesn't need balance sheet. It doesn't need claim on a financial intermediary. That's why it goes so fast, and that's why it's so flexible. So the question, I think, is how do we move towards that, network plus token, as compared to a counterparty relationship between banks. And I think if the authorities want to consider both those objectives, accept that technological progress, and still keep their monetary sovereignty, that is the case for having a CBDC. It's a very strong case for having a CBDC, including in retail. And that's why what the Uruguayan experiment is extremely interesting, because I think they have internalized that as they interpret it. Now, the question is why the big central banks seem to be a little bit sort of reluctant to go that way. And I think that they are too optimistic about the prospect for cash in the future. Cash is still very dominant, cash is still very important, but there may be discontinuity. At some time, the cash use may drop. That's why I asked the question to the governor of the Bank of China yesterday, because it's dropping dramatically in some Chinese city. So it would be very careful to prepare for that.
Okay, very good. I think one aspect here we need to distinguish between functionalities, how can you send money, which you can do in central bank money or in bank money, and one is the central bank money itself as a medium of settlement. I think these are two different sort of concerns. A little question there, and then we give it back to the gentleman over there, and then we give it back.
Thank you. Fernando Fernandez, a professor at the IE Business School. Just a quick question to Tobias on the e-currency, because we tend to forget about the bad times. And the problem is that one of the problems with private money is that crisis happens, and at some times you don't only need the lender of last resort and the money supply control, you also need deposit insurance. So are central banks willing to extend the deposit insurance coverage to the e-money or the synthetic e-money? Because that's the big issue. And if they do, then it's just bank money. There's no difference. And then the fintechs or the issuers of these stable coins will become banks for all practical purposes.
Okay, very good. Thank you. So let's, Samuel, as before, Tobias, would you like to start?
Yeah, I'm happy to start. So let me just make a big picture remark. So the IMF and the World Bank released the Bali FinTech agenda last year that made the point that with these new technologies, you really want to take a balanced approach. As was pointed out, one impulse of authorities is to forbid everything. Another impulse is to allow everything. And probably the optimum is somewhere in between. You do want to take advantage of the benefits of new technologies, but it does come with risks. And having a balanced approach is really key here. And this is where the devil is in the detail. I mean, really thinking through all of the implications and all of the details of these proposals is tremendously important. I did want to point out that the FATF, the Financial Action Task Force, has released guidelines for dealing with the Know Your Customer, AML, CFT, so anti-money laundering, terrorist financing issues that were raised. And in principle, every country around the world has signed up to these principles, except for 1 or 2 jurisdictions that you probably can imagine. Those principles, if they are followed, and of course there has to be an authority that makes sure that the principles are followed, but those are in principle taking care of the KYC issues in the digital cash domain, right? So how to do that, how exactly to implement them is an operational question, but it is something that I believe can be solved. In terms of the conduct of monetary policy, of course, there's the question of whether you operate a floor system or a corridor system, so whether you have excess liquidity or scarce liquidity, and that interacts with the question of whether you want to pay interest on reserves on these interest on these stablecoin reserves in this synthetic central bank digital money proposal. In principle, if you operate a floor system, in principle, you could pay interest on reserves. And some financial economists have actually, or banking economists have actually argued for that. So there's a debate going on. And, if you did pay interest on reserves, at that point, the Brunnermeier-Niebuhr proposal of reinvesting these central bank reserves in the private banking system would be one way to address the concerns that were issued earlier, that there's the potential for disintermediation of the commercial banking system. So, I think this is a whole topic for another panel, and it gets pretty deep pretty quickly. I did want to just finish with one thought about the dollarization question. So, on the one hand, stablecoins have the tremendous potential to undermine the monetary authority of countries. But on the other hand, central bank digital currency is a way that countries are actively thinking about to counteract dollarization. Because there the argument is that, well, we want to get rid of dollarization. CBDC, whether it's synthetic CBDC or CBDC run by the central bank, can actually be helpful to establish a monetary framework and a domestic payment system that operates better than the dollarized system. So I think there again the devil is in the details. So how exactly you implement this system, CBDC can be helpful in counteracting dollarization and the undermining of your domestic payment system and monetary system.
Thank you. Jorge, would you like to?
Yeah. Regarding monetary policy, the management of monetary policy is being challenged in general by digitalization. The velocity of circulation of money, as we said, there is electronic money, there is digital money, and this is being challenged. So let me refer to the case of Uruguay and the proposal of e-peso. E-peso will not make that worse, in the sense that, there could be effects on the multiplier, velocity of circulation, so on and so forth, but on the other hand, we at the central bank will have real-time information about transactions that nowadays we have not. We have aggregate and we delay information. So there are pros and cons on that. Regarding the substitution of the digital currency via deposits, that is possible, but again, it depends on the design and the particular parameterization of the system, as the prevention of anti-money laundering, so on and so forth. Know your customer, all this stuff should be embedded over there. Regarding cross-border, of course, the e-peso does not pretend to be an international money, international currency, just want to serve the service inside Uruguay as the Uruguayan peso. Uruguayan peso is not as appealing as a reserve currency. But there are things related with tourism, for example, foreigners coming to the country and, well, how to operate, and these are technical things we are thinking out because tourism is very important in our region. And regarding the question of the coverage of the deposit insurer, let me say how it works in Uruguay with these electronic money providers. These electronic money providers are some kind of a narrow bank which needs to make reserves in bank deposits. So they are covered in the sense that their reserves are in bank deposits, so they are covered by the deposit insurer.
Thank you. Ewan?
I think this discussion has been very, very helpful, and I think in general the increased attention now being paid to the nature of money, nature of the payment system, has really served a very important purpose of shining a spotlight on some of the existing frictions that we have in the current infrastructure. And I think we, in the policy community, should redouble our efforts to eliminate many of those inefficiencies. I think it's fair to say that the advances in the payment system we have seen in the last few decades has very much been on the user-facing part. It's the front end. It's the fact that now you can use your phone. It's now that it's much quicker with the fast payment system. But the back end, especially on the cross-border settlement, has really barely changed over the last few decades. I think this is where, especially in the central bank community, because ultimately the payment is done through central bank money and settled in central bank money, that this is where the central banks will have to come in a big way. I think the technology definitely adds a new element to the discussion, especially the ability to transfer tokens peer-to-peer rather than having to go through the balance sheet chain. But even here, I think we have to be, perhaps from now on, from the very beginning, to start to think about what would be the institutional backing that would actually make such a system work. Unless it's an open, permissionless system like Bitcoin, which is where anyone can join and trade these tokens. Typically, the cases that we've examined, the cases that Usman mentioned as having undergone experimentation by central banks, have been permission systems, where it's really just like central bank money, but it's in digital form, and it's traded peer-to-peer. So if we were to think about a global analog of that, we have to ask questions like, who would be a member of that kind of network? Who's going to decide whether a particular bank or payments firm is going to be a member? And who's going to vet, who's going to ensure the KYC requirements that Tobias mentioned? So I think in terms of the policy work, we should be working in parallel tracks where we explore ways to improve the current system, and there's plenty of scope to do that, as well as to think of how to set up the institutional backing that could, if needed or if there is a demand, can serve a new system based on a token currency. And as always, we should look back and just learn the lessons of history and try to separate out what's really useful from what is just hype. And I think as policymakers, we owe it to our constituents to actually do that.
Very good. Fantastic. So let's conclude. I think we learned that we have the technology to do something new with central bank money, but the governance and institutional framework obviously are key in order to allow for an orderly integration of these new possibilities into our national and also in particular international payments relations. I would like to thank the Bank of Spain very much and Reinventing Bretton Woods committee for organizing this conference. It's certainly been my pleasure. Let's conclude and have a coffee break. Thank you.